All right. Hello, everybody, and welcome to the live stream. Welcome to another Pepperstone live event here on YouTube. And of course, today we're talking about one of our favorite strategies, which is scalping, but with a little bit of a twist. Of course, we'll be talking about dynamic scalping and how we can potentially find better levels and locations based on some higher timeframes that help us on the smaller timeframes. We'll also understand price a little bit better. As always, I'm joined by Tyra and Abella. Hey, Ty, how you going, man? Are you feeling good?
Good, thank you. Yeah, no, excited. Scalping is one of the topics that is very close to our heart. So yeah, looking forward to jumping into this one.
All right, just making sure we are live and it is all good. So, okay, guys. So basically, we'll be doing a whole bunch of analysis today, but in particular, we'll be looking at acquiring the skills to implement scalping strategies using price action techniques. We'll be seeing how we can allow them to do a little bit different stuff, and more importantly, we'll be looking at ways that we can interpret and process this. Now, what I do think I just need to do here is just make sure we are recording this. So 1 second, guys. All right. I think we are going to have a problem with that. All right. No worries. That's okay. Sometimes technical problems happen, but that's okay. We'll just keep powering forward. So what are we going to be covering today? Of course, we're going to be looking through participants acquiring the skills to implement the strategies. We'll be taking a look at how we effectively analyze, interpret, and of course, use candlesticks more effectively. I think that's a really great thing. And we'll be using equipping traders with the practical steps of managing some risks as well. So just before we get into today's session and we go through each one of these things along with some practical applications into the charts, I do want to give a quick disclaimer. We'll be back in just a few moments. All right, so let's get into it. Advanced price action theory. Now, one of my favorite concepts, Ty, is always to understand things from the basics. And what that means is we need to think about how are we going to place trades better? Many of you out there are going to ask the question, how do big banks and institutions even enter markets? And more importantly, how can we use that to our advantage? Well, luckily, we are going to talk about many of those concepts today. We'll specifically be looking at how institutions build positions, which we've covered a little bit before, but we'll talk about how that builds into a strategy. We'll look at how large positions are represented in price, and of course, how to spot potential changes of trends. How do we do that? What are we looking for, etc. So, Tyron, I think we always know that I bring up Wyckoff, but the main reason to get the quote through, and the quote is that, of course, successful tape reading is the study of force. It requires our ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. Why do we bring this up? So we bring this up because we need to understand that we have to think about the markets a little bit differently. One of the things I think a lot of us fail at doing is when we first get into technical analysis, we think about it as, oh, we use the 20 moving average. And when the price crosses this, it crosses this. And that means that at that exact point, we have to get into the markets, etc. It's like a mechanical approach, but using an indicator. Instead, we should be thinking about what the storyline is on the charts, shouldn't we, Ty?
Most definitely. And look, the storyline, and even with that quote, like breaking it down to its most simple terms, you've got to look at it like you have to have the courage to go in the direction of what the market is actually doing. So many people are focused on actually trying to reverse a trend or trying to pick a bottom or a top. What that quote is really telling us is to actually have the confidence to actually go with the market in the direction that it's going to. That's what it really is essentially saying. So that why we bring it up so often is because it's so true and so relevant to price action in particular, understanding which way that direction is going and having the confidence to go with it. And that will just change the game for you. Whether you're scalping, whether you're long-term, whether you're even medium-term, it makes no difference. The force of the market is where you want to be, not the other way around.
So why we talk about this force is because we want to then apply it to the chart. So let's have a look here on the chart. We've got a bit of a blank page. And basically what we're looking for is we're looking for a market. What does a market tend to do? Well, it looks like this a little bit. Now, whether you're looking at a 1 minute, 5 minute, 10 minute, 15 minute, doesn't really matter what chart you're watching. They will often come into periods where you'll see basically a range bound area. Now, as we talk about this, we know that could be a supply or a demand zone. And more importantly, it can also hold orders. So this is an area where markets are effectively hitting equilibrium. And you'll hear us talk a lot about equilibrium as a concept. Why we do that is because when markets break out from one zone, often Wyckoff called it the markup phase. This markup phase or markdown phase was what we wanted to get into as scalpers, day traders, and swing traders. Effectively, we want to take 2/3 of the honeypot and leave the other third up to the great market makers for getting their positions. So what are they doing as the market comes down? They start to buy a position when they feel like it comes to the correct price. And as the price continues to drop into that zone, they buy more and more and more and more. And then hopefully more and more people get on board that type of thing and it starts to push out. Once it pushes out, it becomes part of what we call the markup or the public participation. And that's what we're looking for. So with supply demand theory, really that's the concept. But I want to go a little bit deeper into it as a scalping price action sequence, Ty. This is where we basically look at markets from the perspective of changes of trend down in these lows. So when the market initially comes down, often it will do this. It's this sequence that we're interested in seeing. What we like to have is that we want to see a base. That's a build of a position. Now, a build of a position means that somebody, a large trader, has probably entered the position early. Now, they don't have traditional stop losses like all of us do they, Ty?
No,
they
absolutely
basically
not.
sit there and they position up and down based on weekly, monthly, and daily occurrences. How does it differ?
Absolutely. And look, that might sound really cool. Like you might say, you know what, that's what I'm going to do as a trader. I'm just going to build my position and I'm not going to worry about stop loss. I'll just keep adding. That is a very, very dangerous game. In no way are we suggesting that you actually do that. Institutions have a set level where for one reason or another, they want to hold that position at a particular price. So they can afford to actually take those positions and continue to average down in them because they have not only basically unlimited capital, but also they aren't fixated on one singular price. Now, you've heard us talk about it before, but really there are 3 different ways that they enter the market. And in their mind, their orders are being filled at different levels, but really they're absorbing what they want, which is actually a big position. So we in no way are saying that to do it in that way, but it's important to understand what is happening in the market and why they're doing it so you can actually take advantage of what they're actually doing. So you don't have to trade like them. You just have to know what they're doing so you can trade with them, really.
Yeah, so when they build a position, remember they don't have a stop loss. So often before a market changes trend, it has what we call a flush, which is effectively where the market comes down, it does a stop loss hunt on us, the poor unsuspecting victims inside of scalping, day trading, everything else. So that sucks, but we often say here on the channel that we want to be basically reactive. We don't want to make a prediction, but what we want to do is we want to recognize market structure. And this is the essence of a good scalping price action sequence. We're looking for the markets to change the trend by usually some kind of hunt or some kind of flush strategy. So once you see some kind of build, then the market breaks down, it breaks back up. You'll know that, well, it's a good chance that that actually is a change of trend on that particular time frame. It can be built around supply and demand, and it's a concept that we really do like. The other thing that we want to think about is when do markets actually change trends? So markets change trend once they break above the previous peaks or troughs. Here's a series of lower lows and lower highs. Then suddenly there's a higher high or a higher peak. Once that happens, we've technically changed the trend. And what we call is our first time frame change of trend. And you'll notice on the downside, it looks like this. Now, first time frame change of trend is a very important concept. It's probably one of the best underpinning strategies to a scalping-based system. And it's these two kind of real slides that I think offer a lot of people a ton of value when you start to think of markets this way. Remember, if you wait for the flush and then it turns in the opposite direction, there's a higher chance that you're going to be correct because the market has significantly changed trend and you can tell the story. And this comes back to exactly what Wyckoff was saying. Storyline is important, and that's what we're looking for.
Most definitely. And you know what? If you aren't automatically thinking in that line, have a look at the replay of this webinar. Take a picture of that and put it on your wall, and you will see that sequence of basically downtrends and uptrends changing in every market that you look at. It'll be amazing how often you will see it once you understand it. So if it doesn't become automatic to you straight away, take a photo of that and put it on your wall. It's very, very important. It happens in every market.
So this is just a couple of things in terms of why supply and demand zones form. In general, as we said, Forex, commodities, stock markets, all of these types of things, big banks and institutions can never place their full position all at once. While we may be able to gain liquidity instantaneously, they've got to push price around. And this is why those zones form. Here's an example of supply and demand in focus, and something that many of you out there could potentially start to build into your strategies for scalping and day trading. And what that is a drop, a base, and a drop. Now, this is a common supply and demand theory. And basically, what it is it's saying we recognize that banks and institutions may have placed a sell position over here, and we can recognize that based on the fact that it did sell. So, therefore, we're being reactive. When markets come back to that area will therefore become a supply zone, and we might be able to scalp that on a smaller time frame. Start to think about markets this way, and it may change the way that you actually perceive higher timeframes, and more importantly, the way you perceive the charts. Here's an example, Ty, of a drop and a base and a drop, and then the market comes up and it tests that. And it may look like that's just resistance, but actually what's happening in here is there are a whole bunch of orders that led to that sell-off. And there's a particular candle here called the long leg doji. We often do look for that on the charts. And we'll talk about that a little bit more in upcoming videos as well, and today a little bit later on. So definitely check out one of the other parts of this. What type of strategies do we want to use this on, Ty? Well, generally, whenever we're talking about supply and demand, we need liquidity. So what does that mean?
Yeah, we definitely want the biggest and the boldest currencies for sure. We want gold. Everybody's talking about gold. 15 years ago, you wouldn't have been able to do it, but gold now is so liquid that you could basically get positions in nearly 24/7, really, if you want. The big currencies, the major pairs, anything US dollar based is always very, very important. And of course, an underrated and probably very, very important instrument is actually the indices. The key world indices are very, very liquid, and they allow you to enter the positions. And really, they're the ones you've got to remember. A lot of the institutions are trading the biggest indices as well. So yeah, wherever they are, that's where the money flow is going to be. The Euro USD, of course, all of the big names. You don't need to be trading exotic pairs to really get the edge. The edge is actually understanding where the market's going. That's the real edge, and the instrument is a byproduct of that. So you really want to stick to the big players there.
Okay, so let's get into another topic. Now, Tyrone, we get asked all the time, candlesticks. Is there a better way of us using candlesticks and thought processes? Well, most of us are all aware of the general candlesticks. When you first start trading, I think everybody knows these two, don't they, Ty? And what are these ones? They are the shooting star and the hammer. And everybody learns these. Some people call them pin bars. What are some other common candlestick patterns that people always learn?
Yeah, look, these are amongst the most common and probably sometimes the most underrated, really. But what you'll come to learn with candlesticks, obviously, where they appear on a chart is the most important thing. But you've got things like long-range candles, bearish engulfing candles, bullish engulfing candles, and then you've also got your candle patterns. The two-part candle patterns are very, very important. You've got your haramis. There are literally thousands of different candle patterns that you could talk about in candlestick formations. But amongst the most important are your doji candles, which tells the story in itself. A doji candle, which we mentioned, basically shows you the range or the progress of that particular period. So if we're talking about a daily move, we can see what's happened in that candle. Now, if we have a doji candle where it's got a long range, but it opens and closes roughly at the same spot, it's telling us so much about what the market's actually doing. This indecision there. You can see here we've got a close and an open very close to each other, and you've got a long range on either side. The wicks are very long, which is telling us that the buyers and the sellers both attempted a big move in their direction, but we really ended up at the same place that we started. And that candle tells us so much about the market and also the structure of where the candle process is. Like if you're looking at that in the middle of nowhere, it's probably not going to mean very much. But if you're looking at that in a supply zone or a demand zone, it's extraordinarily important because it's really telling us that those orders are being fulfilled, and the small money is really what's pushing it up and down, and the big money stabilizes it, and that's generally what makes it move in the direction that you're basically. If it's a supply zone or a demand zone, depending on where the trade is going or the trend is going, that's how you can get involved. But the candle, your first warning sign that this is happening is the doji candle. And in my mind, Tom, it's one of the most important candles because it actually tells us as much about the market as any candle out there.
Yeah, well, I like to think of doji equaling liquidity, Ty. So basically what it is from kind of a supply-demand concept in some ways is it's an area where the market's had a battle. No one's really won at the end of that, but we can be sure that probably there's a lot of trades in it. So what happens is if you see a 1 hour doji, think about what that probably is representing on a smaller time frame. It's representing some kind of probably range bound market. The market's gone up, the market's gone down, the market's ended in the same price. In essence, it's created a level of accumulation or a level of distribution or a level of supply or demand. So really, we know that quite a lot of trades could have gone through there. And in fact, even though they may look like the smallest candles in the bunch, if you check out dojis, you'll often see price react off them after it breaks off and it comes back and tests them again. And this is because, in essence, that's where a lot of orders have been placed. Think of the markets as more of a fractal. Just because we look at a 1 hour or 2 hour or a daily chart doesn't mean there isn't a chart that's a 4 hour and 36 minutes or a 2 hour and I was going to say 80, 2 hours and 42 minutes, something like that. I don't even know how many minutes are on an hour anymore. But basically, yeah, you could have any type of chart and it would still represent, of course, price. So in essence, a doji is showing you the structure of a smaller time frame. I often say to people, if you see a long leg doji, whether it's this or it's this size, which one holds more liquidity? Which one is the largest volume? Well, the answer is we just don't know. We don't have enough information. It may look like it's this one here, which could be B and that's A, but it doesn't necessarily mean just because it's traded to a high and a low range that does hold more. Sometimes these smaller candles hold more orders and more trade because they're trapped in that price, aren't they? There's an equal level of buyers and sellers.
Absolutely. And look, and a lot of people are fearful that, if you get two doji candles in a row, like, oh my God, yeah, that mustn't really mean much. And they cancel each other out. They absolutely don't cancel each other out. In fact, at key market zones, quite often you will see 2 or 3 doji candles in a row. And in essence, that's telling us even more about the market. When the doji's got a friend, Tom, I actually enjoy it. I enjoy a doji with a friend.
Yeah, doji with a friend is a good deal because what will often happen is if you have lots of doji, let's say lots of indecision, then it breaks out. A lot of people will see that as a breakout strategy. One of my favorite strategies is to then see the market come back down to that level. And I bet if you start to look at it that way, what you'll see is that as an advanced technique, often markets will react off these dojis. They'll react off the orders that were placed there because who won? Well, it turns out on a smaller time frame, that's effectively a range-bound market. As the market breaks out, that becomes what we call a demand zone. So there's a lot more to just a candle than meets the eye. And I think part of what we're trying to do here today is to show you as instructional that when you start to think about engulfing patterns, when you start to think about morning stars and evening stars and gaps and all of these other things that happen, or wicks in general, you will start to process things differently. It's kind of like if we were considering this particular price action at this stage, we know that maybe this was a supply zone. Let's say that it was a bunch of long leg dojis, okay, like some little dojis over here. The market comes up and it tests off it. The market comes up and it tests off it. The market comes up and tests off it. Now, in price action, Ty, we would be looking at this as making a series of higher lows. So that would be telling us that maybe it's about to break. At least it looks like there's some momentum that's shifting towards the buy side, isn't there? So that's the type of thing we're reading in price action. And we all try to understand price action that way. Why shouldn't we be applying the same concepts to our candlestick analysis and understanding that there is a storyline going on? Here's another example of the storyline in play, wicks. How often do you see wicks on candles, Tyrone? All the time, yeah?
All the time. And like I say, in the past, it's actually funny, when we first started out trading, seems like many years ago now, we ignored doji candles. Yeah, we ignored them and thought they're just nuisance candles. But really, what we came to understand is that the wicks actually tell us more about the market sometimes than the bodies of the candles actually do.
Correct.
And they really, really are important. But look, like I mentioned earlier, there are thousands of different names for different candles and different candle patterns, but understanding the fundamentals of why a candle is forming and how it's forming tells you the story. It's really, I know Tom has mentioned it several times already, it is a story. And when you understand that story and you know what price action is trying to tell you inside of the patterns, it makes such a big difference. And then understanding the zones becomes so much easier.
So here's an example of wicks and demand. The market comes down, the market hits a demand zone. The market comes up, the market goes down, hits demand zone, the market comes down, etc. But what do you notice about this level? There are wicks on wicks on wicks. Yep. And when you start thinking about it less as a candle and more as a storyline, that's showing you that someone's probably pretty keen on that level. The wick equals orders, and the orders are excited at this level. So once you start to see wicks appearing in zones that you expect liquidity to be at, or you expect that there could be a reaction, whether it's support resistance, whether it's supply demand, it's going to be a very powerful technique as a scalper, as a day trader, and even as a swing trader. And then you can start to apply that to the charts in such ways as this. You can say, well, if we see a reaction off a previous level that we believe is a resistance or a supply, and there's a wick, we can probably say that the algos and stronger trading action has happened around there. So instead of thinking of, oh, I've got to see exactly the perfect shooting star, instead, what we should be thinking about is we just want to see nice wick action. And those wicks are showing us rejection, aren't they, Ty?
Absolutely. And what they are, it's actually holding a level. That's, I think, the important take from that there are attempts at actually breaking up higher, but each of those sequences have actually forced the market down. And like I said earlier, when you've got friends amongst the doji candles, all that's doing is giving it more consolidated time. Now, of course, it's all relative to what time frame you're on, but if you're seeing 5 wicks in a row, that's a week's worth of trading. You know, many markets open in that time. Yeah, you've got market sessions all over the place. That is really telling you a very important story. It doesn't always have to be one, and don't fear multiples. What you want to be seeing is nice, clean rejections. In my mind, you don't want ridiculous wicks. I don't think we need wicks that completely shoot to the stratosphere. As long as they're there as an attempt, so you can see that there was an attempt to break higher, but the market or the big movers have brought it back down to that same level. That's what's important. It's not always the size of the wick, Tom. It's what the wick's telling you, isn't it?
Yeah, it's absolutely what the wick is telling you. Where is it? And as you mentioned at the start of today's video, in the start of this session, we were basically talking about exactly, it's all about where it is and the importance of stacking it with other confluence zones. So, yeah, Ty, the last question we always get asked is, okay, we know about supply and demand, but how can we use indicators with supply and demand in our scalping strategies? Well, we talk a lot about moving averages, and we discuss the idea of using moving averages along with supply and demand, along with support and resistance, to not only potentially analyze it as a trend, but like a trend beginner and something like a cheat sheet kind of way from that. But we also want to use it potentially as a dynamic support and resistance. And this has been one of our favorite strategies that we've used for scalping and day trading, along with other confluence zones. So, of course, the age-old question always comes back to which moving average should we use? And more importantly, which one in terms of SMA and EMA should we be using for scalping and day trading? What is your opinion on this, and which one is generally better for the shorter timeframes?
Yeah, sure. Look, the exponential moving averages are definitely the go-to for us as scalping traders and short-term traders, because they're the ones that are giving us the most relevant information. It's about, it's back in the information as fast as possible. You got to remember that moving averages are lagging indicators, okay? Yep. They're never going to lead the market. They're always lagging the market. So by using an exponential moving average on the scalping strategy, what you're doing is enhancing your chances of getting the most recent and up-to-date information. Although lagging, it's still the most current. Now, an exponential really speeds up price because it's based, of course, more on what's happening in the last few periods rather than the entire period, where the simple moving average actually averages out the whole distance. So you're getting a faster result. Now, that's going to lead to potentially a little bit of false signal sometimes, but more often than not, it's going to give you the clue quicker. So the key to a lagging indicator is making it as responsive as possible without making it that responsive that it's actually not going to really give you a valid signal. So the numbers that we're always looking for are the 20 moving average. That is the one I will take to the grave, Tom. I love my 20 moving average because it acts as an equilibrium of price, and it's the one that you will find pullbacks to no matter what the market is doing. Now, by that I mean, we're talking about scalping here. So if you got a trend on a daily that you know is going up, sometimes you look at the candle and you say, how is it possible that you can even get into that? But when you go down the time frames and actually identify 15-minute chart, 5-minute charts, 1-hour charts, you will find a time frame where a moving average 20 is getting pullbacks on it. Even if the daily looks like a straight green candle that's gone up and given you no chance to get in, you will find a time frame that will get you in if you are looking at a 20 moving average. And I think that's why I like it so much, because it's the one that you will find a trade for if you're absolutely wanting to scalp in the direction of a prevailing trend. Of course, the 50 moving average is important as well. It's one of the ones that we absolutely use as a crossover method. And we're in a volatile market where we are getting big explosive moves. Sometimes the 20 isn't enough to hold the market, and the 50 acts as the backup support. So generally speaking, if we're trending up and it's pulling back past the 20, The 50 is almost the last line of defense. Once it starts going past the 50 moving average in a scalping trend, when you're seeing a series of higher highs and higher lows, generally the last line of defense is the 50. But of course, for support, we can always look at the 100 and the 200 moving averages as well. They're our favorites.
Yeah, so they're our favorite moving averages. And traditionally, most people have used moving average in one of two ways. The 200 is one of our favorite SMAs because, if, as a good little cheat rule, if the market breaks through a 200-day SMA, then generally the trend is mostly up on the daily and weekly. And if it breaks down below a 200-day SMA, then there's a good chance that you're in a downward trend. And that's just a cheat. Of course, we want to read price action a little bit better than that. But where Tyrone's talking about here is the idea of using it as dynamic support or dynamic resistance, and how powerful this is along with demand and supply levels. So here's an example of a 50 SMA, and we see it bounce off that level once. Okay, cool. That's pretty good. Then it comes down to this level, and we can see there's some interesting price action analysis here. Firstly, we get two wick style rejections, which is basically what we call a tweezer. Now, also in this area, we've seen previous buying that has been present. And actually, there is a candle here, which is a long-legged doji. So effectively, this was most likely the liquidity that markets have been buying off as they're coming down. They're buying close to that level. So we hit a 50x or 50 SMA in this case. We hit a tweezer level, which then bounces up. This could be a 5-minute chart, could be a 10-minute chart, could be a 20. It doesn't really matter. Could be an hour, 2-hour daily. It's the same strategy. And what you're saying is you're putting two and two together. You're saying, okay, it looks like potentially resistance becomes support, which is, of course, role reversal. We have a tweezer. That's good for price action. That probably means there's excitement in the orders and excitement in the overall market. And then we also have a doji previously to that, which have been broken above. So that probably means there's a decent amount of liquidity around this area. We can add some extra indicators such as volume profile and other things that would help us in this situation, but it's just a bit of an example. And each time markets come back to this, you might want to be looking to the left-hand side and saying, okay, we've got resistance, we've got support, which is basically, of course, role reversal. We've got some interesting looking wick style candles with and long leg and a little doji in here, which means that it was orders before. And then we're looking for, of course, that excitement of wicks. And here we get more dojis at the break above and then retest down. So there's a lot of great trades to be had actually just on this chart if you start to understand this. It's about building it together. If you were to say to Tyrone and I, do we just trade the 20 moving average all the time? No, you'll lose, unfortunately, because sometimes markets will remain rage bound. But when markets are in a trend and you've seen them touch it a few times, along with supply and demand, such as in this current process here, it can be incredibly good, can't it, Ty?
Oh, most definitely. When you've got supply and demand backing it up, it just makes it a perfect trade. And really, if you're only using that strategy with the supply and demand and the role reversal zone, if that was only your scalping strategy, you're not going to go too far wrong. But you don't blindly just use a moving average and say, I'm going to get that pullback, because that's just not going to make sense, right? Like, you need to have backup. Every case for a buy or a sell position needs a few different reasons to do it. You don't want to be just jumping in because you see something happen very, very quickly. Generally speaking, we go generally 3 to 4 reasons, sometimes even 5, depending on how risk averse you want to be. But a minimum of 3, Tom. You just don't look at anything under at least 3 solid reasons to actually take a trade.
And they have to be separate.
Most definitely. It can't be the same thing. You can't have a 20 moving average and then another 20 moving average SMA, because it's pretty close. And then a Bollinger Band in the middle of the Bollinger Band. That's all the same thing. You're looking at the same reason. They've got to be very, very different reasons. Moving averages tell you one story. Price action is very, very important, tells you another. Support and resistance is another reason as well. There's 3 different reasons that you can use as a base. Then you could add things like Fibonacci's, of course, and there's also RSI. But in reality, though, you must have at least 3. And my personal rule, one of those 3 has to be price action. Price action has to be one of the rules always, no matter what you're adding to it to place a trade.
So the question always comes back to this thing, Ty. Which is our favorite moving average? Well, I'm always going to say that you're going to say the 20.
Yes, you can't steal mine.
And I know we try to steal the 20 from each other, so I'm not sure which one we're going to go with there. But let's say the 20 is definitely a good one, and that's because it's based on also a calendar month. It's also based, so if you did on the daily, approximately 20 trade days, but it's also just so well used. Now, I've been looking at a few reports recently, and interestingly enough, the 50 and the 200 were in those reports. Now, these were reports from Morgan Stanley, from a few other places, Goldman Sachs, a few other places they've been using them. So I would probably say the 200 is also an exceptionally good SMA. And the reason it is although it's not great maybe for a scalper or day trader, it is certainly incredibly good as an investment vehicle, because oftentimes you'll see the 200 SMA, if you put that on an index such as the S&P 500, when the market pulls back down to that one, you'd be surprised how often that is actually the bottom of that corrective move. So something to maybe check out and have a look on your charts after watching today's video.
It's very important for market sentiment, the 200, because a lot of the big players, big channels, big reporting institutions all mention it. And it is a sentiment indicator as well. So, you know, when markets are trading above or below it, it does say something about the overall sentiment of the market. So that can't be ignored.
All right, well, let's apply some of this to the charts now. And we'll take a couple of questions. So if you do have questions, feel free to put them through on the chat. Here we go. We've got Manoj saying, welcome. Thank you very much for joining us. Shall we enter on a breakout or wait for the retest? Generally, you'd wait for the retest for that question, which comes from, I believe, the first section of today's video, which was to do with price action and the strategies there. We would look for the market to pull back, because if it doesn't pull back, then you're not really going to get the right risk reward. A good example of this would be this type of trade down here. So the market kind of, what it does is you can see there's a little action here. The market makes a lower low. The market makes this huge movement, and then it comes back and it almost goes below the low, but that low has already been flushed. So what then happens is you get a buyer that comes back in. And that's quite, you know, obviously it's acted quite strongly since that point. On an example of the downside, where we see this is, of course, a 2-hour chart, but an example of the downside would be, well, there's another nice one from the upside, actually. So here's a beautiful low, a high, a lower low, a higher high, nice pullback. When we enter here, we only have to have a stop loss below the low. And that could be a 5-minute chart. But if you look at the sequence, you'd be surprised how well those sequences do work, especially when stacked with other reasons.
Yeah, we personally always wait for the retest. Look, there's no hard and fast rule, but you know, our mantra is patience, react, don't predict. The patience is waiting for that pullback. Look, now it doesn't happen every single time, but in my mind, the ones that we do miss because of that aren't the end of the world. It's going to pull back more often than not, and the pullback gives you the reassurance and a lot more momentum in that direction. And most importantly, like Tom mentioned, the stop loss is far more accurate in that regard. You get the risk reward that you really actually need to apply. So I think that's why it's so much more important.
Yeah, they often say buy the V is better than buy the dip as well. So what that means is if the market comes down, this is more of an investing strategy, but if you buy the dip, then the problem with buying the dip is that it could keep dipping. It could keep dipping against us. Buying the V, well, that gives us quite a lot of information. We know where potentially our stop loss could be. We also know that the price is in the momentum of the location we're going. A very powerful, underutilized concept. The problem with buying the dip or buying or selling the rip or anything like that is you're making a prediction. And that prediction is that you believe it's going to stop. Where are you going to place your stop loss? You're not like an institution. It's going to be very difficult for you to do this. It leads us into the next question. Brian says, how long do big orders take to place? I.e., what time frame do we include the volume profiles, etc., in analysis work? Generally, you want to do it over a decent period of time. He says, is it 1 hour? Is it a week? You want to do it over structure. So instead of saying, oh, is it a 1 hour or a week or anything, think about it as a structure. So let's say we go to a daily and we see a range-bound market. So we see a market that's basically sitting in a zone. That most likely is a build of a position. Do we know which way it's going to go at that point? No. Do we know which way it goes when it breaks out? Well, yes, it's coiled. So when a market coils, you should be looking at that as an explosive opportunity. So a good example of a coil that's happened just a few days ago was literally Bitcoin. You can see here, Bitcoin was sitting and sitting and sitting. Did I know which way it was going to go? No. Maybe odds were it was possibly going to go short because the trend was down. But then we see the Bitcoin ETF get announced, or at least announced that it's probably been passed. That then sent it up to this level. So, of course, it exploded it out. At that point, you would know that, of course, this is a range market. You could put a volume profile on it and et cetera, et cetera. And you'll notice I've got most traded zone here written. The reason is because throughout all of this structure, that is a heavily traded area. And you want to think about that even as a day trader or as a scalper, because when price hits that point, you can see the reaction that it has off it. There is a little sell that suddenly came through. That's because people take profit at these zones. What was traded heavily before could be traded heavily again. Just like if we come up to this level up here, Ty, we have to expect on this blue line here that there could be a reaction. If there is a reaction in a replicable way in our trade system on the smaller timeframes, then we might want to get involved in that trade. And of course, that's something that we could be doing analysis on before it even comes into it. Riza says, my favorite broker. Thank you very much. Pepperstone's great. And of course, check them out in terms of activating them also with TradingView, which is the platform we're using here if you're interested in doing that. And Mohammed says, I love FX Evolution. Thank you very much, Mohammed. Appreciate it.
Thank you, Mohammed. We love each and every one of you too.
Yeah, well, that's true. We love Mohammed because he said that, but we also love everybody else. It's
absolutely. We love and appreciate that you guys take the time to listen to us and hopefully learn something. So Andy says, how much confirmation do we look for prior to taking a trade, or do we simply buy the next red or green candle after a break above or below the 20 EMA? Look, that question, Andy, really depends on what sort of time frame that you're trading, what sort of trader that you are. If you're a scalper, what you're going to be looking for, this is how, let me break it down to you. If I see a 20 moving average touch, okay, so say we're trading a long position and all of a sudden it pulls back down to a 20 moving average, which presents an opportunity. If you're a trader that has no time whatsoever and you have to take maybe a couple of hours of looking at the charts in a week and that's all you've got, then you're probably going to be one of those people that's going to have to trade that candle simply because you just haven't got the time to actually break it down. Me personally, what I would do if a day candle touches the 20 moving average on a pullback in an uptrend is I would go to the smaller time frames and look for the momentum shift. So what we're looking for is, you know exactly where it is on the daily, you know it's on the 20 moving average, but I would go down to a smaller time frame, say a 1 hour or a 4 hour or even sometimes a 15-minute if you're scalping, and look for that change of trend that we talked about. A series of higher highs and higher lows confirms the momentum. So not only do we get a confirmation that that 20 moving average has actually indeed held price from going lower, but we've also got confirmation that the smaller time frame has actually moved that momentum up. So the shift in the smaller time frame has actually started to increase, and that momentum is starting to build to go in the long direction again. Now, all momentum and all trends start from the smallest time frame and work their way up. Remember that. So you're not going to go too far wrong by doing this, but sometimes you haven't got the time. And I do totally understand that. Not everybody has the time to analyze it down to the nth degree. So it really comes down to which time frame you're trading, how you apply your trades. Are you an end of day trader only? You may not get those opportunities to go to the smaller time frames and look for the higher high, higher low sequence, and you may well have to enter on the next candle. There's no wrong or right, but the more you can add, and going to the smaller time frame, of course, is going to increase the probability of that being a strong position because you know the momentum has already shifted.
Yeah, so it is all about understanding that higher time frame analysis can go into the shorter time frame analysis, and that's, I think, a big thing. Confluence of different techniques is also important. Remember, it's not just the 20 moving average, to Andy's question, and this is just an example of Apple recently on the daily and how it interacted with it. You can see even when it hit the 20 the first time, it did see a little sell, followed by, of course, in this case, it broke through. That could mean that now if it comes back to the 20, that may act as now dynamic support. So you'll be wanting to look potentially at a zone like that as a potential opportunity. Now, I'm sorry to hear that. I think it's Levy that's come into the room. He says he's unfortunately come on hard times, maybe hopefully not from trading, but it sounds like it's been a bit rough. Well, what we'd suggest is, of course, you do try to educate yourself and try to upgrade your skills. And one of the ways you can do that, and everybody out there as well, can watch some of the other webinars and live sessions that we've done. We've offered a whole bunch of education here on the platform, haven't we, Ty? And that's been that's obviously helped us to build a pretty good structure. And I think that a lot of you might want to check out some of those other live sessions on YouTube on the Pepperstone platform and make sure
there's a lot of learning there. Absolutely. Look, look, Levy, the most important thing that we can probably tell you is don't make the mistake that many do and try and pull your way out of hard times by trading and taking big risks. The best thing that you can do is get yourself educated. Always use really, really good risk management, because it's a long game. It's not a short game. Don't try and get yourself out of trouble by trading, because probably 9.9 times out of 10, you'll end up in a far worse position. Always get yourself educated. Take your time to learn it properly, and then use it as a tool. Don't try to get yourself out of it by doing it, because it's no different to going to the casino if you're going to do that. And yeah, you certainly don't want. Sorry to hear that, and hopefully, yeah, some good times are ahead for you.
Yeah, I hope so too. So, look, at this point, guys, what I think I'd like to say is, of course, check out our library on Pepperstone's YouTube of all the other things we've done about market structure. Start to understand that markets are really about being patient and reacting. Maybe even reduce some of your trading. If you feel like you overtrade, start to bring it back, start to look for Confluence. And guess what? Set alerts. We're going to use that as the end for today's session, because setting alerts is so key. It'll save you time. It means you're not a slave to the charts. And more importantly, when the right price is shown, you're going to get that alert and then be able to come in and hopefully have a bit of a plan around it, which is really important. So, Tyrone, I always enjoy doing these sessions. We will be coming back next week, won't we, with another great session. So make sure to check that out. And as always, I'd like to say a big thank you for spending your time here on the Pepperstone platform and the Pepperstone YouTube Live. And we'll see you in 1 week's time for another learning, hopefully, experience. Yeah.
Absolutely. Thanks very much, everybody.
Thank you, guys. Bye for now.